All right, starting out, let's just talk about the bond market. I know that's where you guys like to focus a lot and what rates are doing. But before we talk about today and what you're seeing, maybe give just kind of a brief history of the last year, or really since the Fed started tightening, what you guys were paying attention to, what was interesting, kind of track us where it's been since since inflation picked up and the Fed started acting, and then we'll get to today and what you're paying attention to.
Yeah, absolutely. So that's an awesome jumping off point. Basically, for the entire last, we'll call it year and a half, right, since October 2021 per se, inflation really began being a problem in the middle of 2021, and then beginning in October of 2021, the bond market started moving, and the front end started moving first. Now, each tenor along the U.S. Treasury curve tells us something, right? Every single period in time that you can invest in, each instrument tells us a little bit about investor behavior based on the price action. Within bonds, for those of you who aren't aware, as the price of a bond moves up, its yield moves down. And so we monitor the yield along the US Treasury curve to give us some signal about what investors are anticipating is going to happen. The front end of the curve, specifically the 2-year yield, that is a good proxy for the policy rate, right? What does the market think the policy rate is going to be 2 years from now? And in October of 2021, it started moving up pretty considerably, right? It started moving up as the 2-year note sold off. And that was basically saying, the bond market saying, hey, we anticipate the Fed is going to raise interest rates. Lo and behold, 5 months later, March of 2022, the Fed hikes for the first time. They hiked by, I believe it was 50 basis points. So they hiked once by 50 basis points, and then they hiked 2 more times by 50 basis points, right? These are already large increments by which the Fed can raise its policy interest rates. Now that I say policy interest rates, because the Fed doesn't actually raise interest rates per se. When people think about the Federal Reserve, they think that it's this governing body that actually sets interest rates. It actually tries to influence interest rates. The way that it does that, it has various tools that we don't necessarily need to get into. But its main tool that it uses is its suite of policy rates, and the main one that gets referenced is Fed funds. And so the bond market was basically predicting that the Fed would raise rates, and it did. And we have an expression at the Bitcoin layer that rates lead the Fed. Rates move out ahead of what the Fed is going to do. And so we use the 2-year yield as sort of our guide for behavior that the Federal Reserve is going to take. And all throughout 2022, it was the exact same story. Twos were ripping into the stratosphere. They reached as high as 5.5% at points, basically predicting that the Fed would reach a 5.5% terminal rate. But as of recently, with the Fed's aggressive hiking, they have obviously downshifted the pace of their hikes. And with that, you've also seen the 2-year yield, which, as I said, is a proxy for the Fed's policy rate. It's fallen down below the policy rate, right? So twos has actually inverted the federal funds rate by a full percentage point now, right? So the federal funds rate right now is 4.8. That's the effective rate. The upper bound is 5%. And the 2-year Treasury yield is much, much, much lower than that. I have it in front of me. It's 385, and actually today it's closer to 360. So 3.6%. It's 1.2 if you're going by effective, or 1.4% below where the Fed wants to influence policy. Now, I mentioned the Fed doesn't set interest rates; it tries to influence them with its set of tools. So if the interest rates that you are trying to influence are lower than the level you're trying to set them at by a full 1.4%, your tools no longer work, right? Your tools, more interest rate hikes are futile because you can't actually effectively influence front end rates up any longer. And effectively, what the rates market is saying here is that it expects the Fed to not only stop hiking but cut rates. Now, why does the market think this? Well, if you go a little bit further out along the curve, you notice that longer tenors, like the 10-year, like the 30-year, they are also falling pretty considerably. Now, the 10-year specifically, it can be taken as sort of this proxy for growth and inflation expectations. And in a credit-based monetary system, inflation and growth are very much interlinked, unfortunately. Credit expansion is necessary in order for growth in the real economy to occur on a positive real basis. And so the 10-year yield is sort of your proxy for growth and inflation expectations. Now, the 10-year yield has also fallen rather drastically. It's currently right around 325, which is very, 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 very crazy price action. It like the 2 year yield started rising in 2020, actually before the 2 year yield, but it reached almost as high as 4.5%, and now it's moved down to, like I said, 325, the 325 area, and this is actually the lowest it's been in 7 months, right? So since last September, and really, there isn't any sort of support below this level, or resistance rather, because we're talking about price, and price is inverse to yield, right? And so there really isn't any resistance for this level. Should it break, it's really look out down below for the yield. And this is really indicative of the broader growth slowdown that's occurring, right? Credit is contracting with banks. We've seen bank failures left and right. But even on a less severe basis, you're seeing less loan syndication um, from banks, right? So banks are actually packaging and selling less loans in the form of securities to the public. What does that mean, right? They're extending less loans, and so therefore they're selling less loans to the public, right? Public appetite for actually funding these loans is going down, and so there's this credit crunch where credit growth is broadly slowing, and like I alluded to, in a credit-based monetary system, credit expansion is growth. And so when credit dries up and new credit stops being extended, growth falls through the floor. And that's what the bond market is saying, with the 10-year yield falling through these targets. That's what the front end of the curve is saying, with expecting policy cuts. And that's really what you see broadly in the demand for commodities. And I'm sure we'll talk about what happened with OPEC. I know that you can add some color there, because you certainly have more expertise than I. But there have been a slew of OPEC cuts, production cuts, over the last year. And they've been falling below all of their production targets, anyways. And so many people see this OPEC cut as inflationary. But in actuality, right, with the crude price falling over the last year and then some, and the fact that over the last 3, 4, 5 years, right, the sort of median price, you could call it, has been 40, $50, and we're still trading at $80 a barrel, despite this most recent line of cuts. It shows you that this is just a demand response function, right? It seems to me like global demand for crude is falling, and that's why these cuts came. So rather than being inflationary, they're a demand response. And so everywhere you look, this credit contraction is occurring, right? And of course, with that will come this growth slowdown, and you're already beginning to see it in some of these leading indicators like commodity prices. So that's basically what the bond market is signaling, and what I'm witnessing in markets more broadly. But I'd love to get into it.